If you look at the distance between firms in China and firms in the US, that distance has actually increased. And I think this is very consistent with some of the trade data we've seen, for example, on the growing role of countries such as Mexico and Vietnam as, if you like, the staging posts in that supply chain link.
But finally, central banks have been able to regain the room for policy maneuver that many policy frameworks were actually designed to yield. And of course, it would be a pity if this room for maneuver was squandered. From a longer-term perspective, it's important that monetary policy operates with what we call safety margins to deal with both the expected and the unexpected. The expected is recessions that are bound to come. The unexpected are the types of COVID shocks that we saw.
Hello everybody, and thank you for joining us. I'm Jill Ford and I'm pleased to welcome you to today's media briefing about the Bank for International Settlements September Quarterly Review. With me today are Claudio Borio, Head of the Monetary and Economic Department, and Hyun Shin, Economic Advisor and Head of Research, as well as the authors of the special features. So Mr. Borio and Mr. Shin will give brief introductory remarks and then we will open the floor to questions. We'll take questions on the overview and then on the features. So let me hand over to Claudio. The floor is yours.
Thank you, Jill. And thanks to everyone for joining us today. In this quarterly, we review financial market developments from the 1st of June to the 6th of September. This period saw heightened, one may even say hyper-sensitivity to macroeconomic news, which triggered a sharp but short-lived volatility spike in early August. While inflation continued to drift towards targets, slowdown concerns led market participants to anticipate sooner and faster rate cuts, especially in the United States. The corresponding narrowing of expected policy rate differentials halted the divergence that had helped sustain the US dollar appreciation. And by the end of the review period, despite some volatility jitters, risk-on was again ruling over financial markets. Let me turn briefly to the August turbulence. The overreaction to what financial market participants had perceived as hawkish Federal Reserve and Bank of Japan policy meetings, and to weaker than expected US jobs data, triggered a sharp US stock market correction, the unwinding of so-called currency carry trades, and an even larger drop in the Japanese stock market. By carry trades, we mean investments in higher-yielding currencies, for example, the US dollar, funded by borrowing in lower-yielding ones, for example, the Japanese yen. Typically, carry trades rely heavily on leverage and on an expectation of low volatility. Such positions tend to balloon in periods when volatility is subdued and funding liquidity ample. The carry trade unwind on the 5th of August reverberated globally and was part of a broader deleveraging of positions that caused the VIX volatility index to spike. Intraday, the index reached levels more typical of extreme market turmoil, such as the COVID crisis. Shedding light on the episode, one of the boxes in the overview gauges the sensitivity of hedge fund returns to carry trade position. It finds that trades had become crowded in the run-up to the event, and that some players had also become more sensitive to an equity price correction. Another box explains how BIS statistics can help trace the footprint of the carry trade in on- and off-balance sheet data. This box too finds indirect evidence of substantial growth in these positions. As it turned out, markets stabilized remarkably quickly and recovered in a matter of days. This suggests that less leverage-constrained investors could quickly step in and buy the dip. Moreover, subsequent less negative data releases and central bank communication calmed investors' nerves. But we should be under no illusion. This is not the first and will not be the last turbulence in markets. At this juncture, it is part of a bigger picture, the inevitable withdrawal symptoms that markets suffer as they transition away from the extraordinary period of exceptionally low interest rates and ample liquidity that has prevailed for so long. Overall, financial conditions remained accommodative as markets shrugged off the turbulence. To be sure, equities saw some notable corrections, particularly for AI and tech-related stocks, but valuations remained generally elevated. Likewise, credit markets were relatively unscathed. Corporate bond spreads widened only marginally across advanced economies, while banks appeared to stop tightening lending terms. Hence, a certain contrast between the gloomier outlook priced in government bond markets and the rosier one in corporate bonds and other risk assets. Emerging market economies were also tested by the unwinding of carry trades and bouts of volatility. Some high-yielding currencies depreciated, especially in Latin America. And the contagion spilled into Asian currency and equity markets. On balance, though, EME financial markets largely held their ground. The prospect of a reversal of dollar strength provided some relief. Apart from the two boxes I have already highlighted, a third one illustrates the recent hypersensitivity of markets to data in the United States, especially to labor market releases. And a fourth one compares the recent evolution of tech stocks with developments during the dot-com period. So now let me turn to Hyun, who will present some of the other highlights of the issue.
Thank you, Claudio, and welcome everyone. The special features in this quarterly review cover a range of topics. One of them explores the evolving business model of life insurers and financial stability issues in that sector. Fabian Garavito, Ulf Leverick, Thomas Stasny, and Karen Phil-Todorov show how life insurers have increased their exposure to riskier and less liquid asset classes and engaged in complex reinsurance arrangements, much of it with offshore centers. The authors estimate that US life insurers have transferred liabilities worth $2.1 trillion to offshore reinsurers. The article delves into the motivations behind these so-called asset-intensive reinsurance activities, emphasizing the role of private equity firms in facilitating these investments and the desire to economize on regulatory capital. This trend has led to an interconnected and complex life insurance landscape, raising financial stability concerns. Another piece by Han Chu, Dora Shah, and James Yetman analyzes the effect of evolving geopolitical alignment on trade flows using detailed bilateral trade data. The key concept is the notion of geopolitical distance between countries based on voting patterns at the United Nations. When comparing data from 2017 and 2023, the authors find that trade volumes grew 2.5 percentage points more slowly between countries that are more distant, according to the geopolitical index, than between countries with closer ties. The authors assess the challenges of geopolitical risks, particularly for countries that are more heavily dependent on trading partners that are more distant in geopolitical terms and who have limited alternative options. These results highlight the potential consequences of fragmentation of trade as countries impose trade restrictions against geopolitically distant trading partners. Gaston Gelos, Pietro Patelli, and Ilyok Shim examined the influence of US dollar and other key drivers of capital flows, such as the VIX and policy rate differentials, especially for emerging market economies. They find that a depreciating US dollar boosts investment in EME local currency assets, such as local currency bonds and equities, while changes in policy rate differentials affect foreign currency loan flows. The overall effect of the fluctuations in the dollar on EME local currency flows has become more important over time. The authors point to the growing role of mutual funds as one of the factors behind this trend. And of course, EMEs may draw on these insights in their policy frameworks. Finally, and not least, let me mention the latest piece in our special series on the insights that can be gained from the BIS International Banking and Financial Statistics. Brian Hardy, Patrick Maguire, and Gertz von Peter provide an overview of how these statistics can be used to understand risk exposures on a consolidated basis for banking groups that have a global footprint. The consolidated data provide an alternative and complementary perspective from the usual statistical practice of focusing on the locations where the business is conducted. The consolidated perspective is especially useful for credit impairment resulting from financial and economic crises and other non-credit shocks such as wars and sanctions, which have macroeconomic consequences that expose creditor banks to potential losses. the BIS consolidated banking statistics track banks' exposures to such events in different jurisdictions on an aggregate basis. The article illustrates how banks adjust their exposures in response to changes in country risk through several recent examples.
Thank you very much, Hyun. And now we open to your questions. Alice Atkins from Bloomberg has a raised hand. So, Alice.
Thanks for the briefing. I've got a question to follow up on carry trades. And you mentioned in the report that it's becoming increasingly difficult to track the size of carry trades. So how is the BIS working to enhance FX derivatives data to help monitor carry trade trends?
Yes, thank you, Alice. We can get a different gauge of the size of the carry trade through different channels. One way would be to just look at our on-balance sheet data, which is to say the formal lending that's done by banks in yen. And the number that we report on the cross-border lending that's yen-denominated was 40 trillion yen as of our latest reading. But as we argue both in the overview and also in particular in box D, that's probably going to be only a very small portion of the likely method of actually constructing the carry trade position, because you can also construct the carry trade using off-balance sheet transactions, especially FX swaps, where you sort of one party delivers one currency and receives another currency in return, with the promise to unwind that transaction at a fixed point in the future at a pre-agreed exchange rate. And as we explained in the box, if you then just sell the currency that you receive on the spot market, you're left with an unhedged exposure. You're left with an unhedged liability, and that is certainly another way of constructing the carry trade. So what we explained there is that that aggregate position is very large. It's $14.2 trillion as of the latest reading, where we have the yen on one side. Most of that will be hedging transactions where investors will borrow dollars in order to invest in dollar or other currency denominated assets outside Japan. And one thing that we will need to do is to have better data on the direction of the trade to get a sense of what the economic purpose of that transaction actually is. And this is something that we're working at the moment to bring about. The other way that we could put some additional details on these trades would be to look at where these transactions are booked. So currency is one dimension, but the location would be the other dimension. And that's also something that we're working to incorporate. But this is going to entail some additional data collection, and this is something that we're actually working with our member central banks on.
We're working on this. It's going to take some time, and particularly sort of breakdown in terms of location and counterparty will provide some additional information. Now, the other point that I wanted to draw your attention to, though, is that we have another box that does away with looking at specific data, quantity data, and is much more focused on returns and the sensitivity of fund returns to particular risk factors. One risk factor is indeed the carry trade. Another risk factor in the box is equity market. Could be the VIX, could be yet another factor, which we could identify separately. And that type of analysis actually is quite complementary to trying to find the size of the trade by looking at on and off balance sheet data, which, as you saw, provide large, wide ranges. So although all the messages are very much in the same direction, the trade was large and it was growing. But also this additional type of way of looking at things provides very useful complementary information for two reasons. First of all, it's much more up-to-date than the other data. No matter what improvements we're going to be making to those statistics, there is always going to be a reporting lag, which is going to be quite long. And the second reason is that it provides some sense of the correlation of the exposures. which also helps to explain why, for example, we saw both equity markets dropping and currencies being affected at the same time.
Thank you, Claudio. We'll now go to one of the written questions, which is from Maureen Khan from The Times. Could you comment on how central banks should best respond to the bouts of market volatility, such as those seen at the start of August? Do central banks need to communicate calm to investors or let events play out? Claudio.
Well, this is, of course, is a question that central banks have been struggling for a very long time, and it's ultimately a question of judgment. But I guess two principles are very important. One is to make sure that you keep your ultimate objectives very much in mind, which is those will slightly vary from central bank to central bank, but clearly price stability and financial stability are key. The second is to make sure, as we saw, for example, in the case of the Bank of England in September 2022, which was to make sure that you try and differentiate as much as possible your actions designed to deal with the financial stability turbulence on the one hand, and those actions that are designed to deal with your ultimate macroeconomic objectives, price stability, and so on, to make sure that you're not actually confusing markets. And in all of this, then, of course, there is an ultimate principle, which is, again, to make sure that to avoid overreaction to these things. And therefore, allowing things to play out as long as they do not become systemic is clearly a good strategy to follow.
To Joasha Popovic from Central Banking, I think you're next.
Good afternoon. No, thank you very much for the report. My question is on the geopolitical relationships and their impact on trade. I noted that unfortunately there wasn't enough data to include countries like Russia and Korea. I wonder though, with sort of whether it's possible to comment on observations or expected trends with regard to what we'll be seeing between countries that are geopolitically distant. Just to follow up as well, what that might mean for the dollar's dominance as well.
So what this piece shows is, it's a rather ingenious way of gauging geopolitical distance by looking at the voting patterns at the UN. It's actually drawing on some earlier academic work that done by international relations experts, and it does seem that it sheds some light on recent trade patterns. The other thing, of course, this is just two snapshots between 2017 and 2023. To the extent that these trends will continue, it might be reasonable to expect, or it might be reasonable to extrapolate, some of these trends. I think what is not being fully captured in this study, but something which we did do in an earlier bulletin last year, from October last year, was to look at the firm-to-firm connections. So this is really looking at country-to-country trade rather than firm-to-firm trade. And what we can find when we look at the firm-to-firm trade is that, yes, there has been some rejigging of the networks between firms, but there is also a lengthening of the supply chain itself. So one of the findings is that the distance between firms, as measured by the number of connections, so you can define a distance between two firms as the shortest path by going through the balance sheet connections from one firm to the other. And it was interesting, for example, there that if you look at the distance between firms in China and firms in the US, that distance has actually increased. And I think this is very consistent with some of the trade data that we've seen, for example, on the growing role of countries such as Mexico and Vietnam as, if you like, the staging posts in that kind of supply chain link. So we see this as very much one element of the growing literature on this issue. We also look at the distinction between So this feature is also distinctive in that you can look at the trade volumes as well as the trade values. So to the extent that it's the price of the exports and imports that are changing, you can have the same volumes, but simply but the value could change because the price is changing. What this feature finds is that it's really the volume itself. So these changes do seem to reflect the underlying quantitative sort of magnitudes that are out there in trade.
As the authors report, the numbers are roughly similar to those from other studies. But what's particularly interesting about this study is that it looks at much more granular information, sectoral information, and that can provide a richness to the analysis that other studies don't have, including the calculation of some of the vulnerability indices that you saw at the back.
Mark Jones from Reuters, you've had a hand raised. So do you want to ask your question?
You're releasing this on Monday, and obviously the Fed's expected to start its rate cutting cycle that week. And I know, past reports, there's been the debate about the last mile for inflation being very tough. Is there a general acknowledgement that the time has now come for the Fed to make the pivot? And what are the thoughts going forward in terms of its pace and what it needs to do? And the debate on also ultimately the neutral rate. The market seemed very confused about it. As one of the other people touched on, the communication issue is there, and also is there a credibility issue here? Considering if they do start to move very quickly, the markets will question whether they've got credibility still.
We'll answer that by saying we don't really comment on the future monetary policy decisions, but let's answer it, I think, in general terms. We'll do our best, Claudio.
I think that the situation has further evolved from the time when the annual economic report came out, and it has evolved for the better when it comes to the inflation outlook. That's very much good news. The overall message, if you like, that we provided in the annual economic report still stands, which is a message of prudence and in terms of the ease of pacing going forward. This does not apply to any specific central bank. It's a more general message that we have there. Each central bank will decide at what pace it will move in relation to the country-specific circumstances. The general message about prudence still stands, and not just from the point of view of the possible outlook for inflation, which has improved, as we said, but also with respect to the fact that we're coming out. If there is a silver lining to this inflation spurt, has been that finally central banks have been able to regain the room for policy maneuver that many policy frameworks were actually designed to yield. And of course, it would be a pity if this room for maneuver was squandered. From a longer-term perspective, it's important that monetary policy operates with what we call safety margins to deal with both the expected and the unexpected. The expected is recessions that are bound to come. The unexpected are the types of COVID shocks that we saw. So that is one additional consideration to bear in mind when deciding the pace and how far to go. When it comes to our star, the key message of the annual economic report is this: as you actually said, it's a rather blurry concept, and you find out when you are where our star is when you get there somehow. That is, when you reach the soft spot in economic activity in terms of financial and monetary stability and price stability going forward.
If we go now to, I see Alice Atkins with your hand.
Hi, sorry, one more question from me. I was keen to follow up on carry trades and whether you think that these bouts of cross-market volatility are going to become more frequent due to hedge funds' use of leverage and the popularity of the strategy.
I think certainly the bout of market volatility in early August, will have impacted some existing positions, and to the extent that those positions were unwound, I think going forward the risks may be less. But I think what you're pointing to is, if you like, the longer term issue of just the general principle that when there is the incentives for carry trades open up, that there is an ecosystem of financial institutions that are ready to fill that space? And I think the answer, would be very possibly. And so we would need to have a very keen eye on the potential risks that are building up. I think one thing that has come through from all the commentary since early August is that, although the carry trade unwind was something of a lightning rod that really focused all the attention on that part of the market action, it's fair to say that that part, the carry trade unwind, was probably part of a larger deleveraging process that involved many more actors and in many more markets. And the fact that it was the equity market that was impacted most rather than the fixed income market is also, I think, indicative of possible spillovers from different across different market segments, because normally equity markets would not be very tightly bound with what's happening in the currency markets. It's much more the fixed income, I would say, which is much closer to the currency markets in a much more direct portfolio way. And so this points to the importance of potential amplification effects through the way that we manage risk. And how risk constraints might bind across different strategies. And I think here the institutional details will matter. So, if you have one firm and there are different teams engaged in different strategies, if there is a risk tightening across the board, then this will affect all the different strategies in a pretty uniform way. So that could be a channel for the types of spillovers that we saw. So I think these are, all pointers to the importance of keeping a very close eye on what the commentary is suggesting as to what the market participants are engaged in. And because financial conditions are really key for the conduct of monetary policy, of course, this is of first-order importance for central banks.
Yes, just to underline what Hyun has just said, and to maybe put it in an even broader perspective. I mean, these types of episodes are inevitable in financial markets. I mean, this type of volatility is to a large extent inevitable. I've been in this business now for quite a number of years, and in fact, my first assignment was to deal with a stock market crash as far back as 1987. And all these issues about dynamic hedging and so on were already very much present then. So we'll have to live with it, and we have to learn to live with it. Beyond that, however, we also know that there are certain conditions that favor these types of buildup of leverage positions, which, by the way, did not take market participants by surprise. Everyone knew that there was a lot of leverage out there. There were large positions. But I guess you can all remember Chuck Prince's famous or infamous quote that as long as the music is playing, you have to get up and dance. And that's basically what market participants were doing. But we also know that certain conditions facilitate the buildup of leverage. And as I mentioned in my initial remarks, very easy financial conditions over a long time, ample liquidity availability is clearly something that allows you to build up more leverage, that allows you to take on risk, and therefore that allows this self-reinforcing processes to take hold and, the music to last longer until it suddenly stops.
Thank you, Claudio. So I think I see what is the last question that's coming in, which has come in on the chat from Natalie Olaf Ors. So she's going back to, from Agence France Presse, and she's going back to the feature on global trade, asking why did we prepare a report on that, given that there's been various reports already from the insurance sector in particular, and asks to explain why this can also be an issue for central banks, and asks why central banks should be mindful of this risk.
Natalie, you're mentioning both the trade special feature, but also the insurance special feature. Let me just take the trade special feature first. Why did we do this? Well, global trade is clearly a very, very important part of the macroeconomic conjuncture and of great relevance to central banks. So we think that this is a very natural area for us to investigate. We do have quite a global perspective, and so I think we're very well suited to examine this particular issue as well. And finally, let me also mention that there is a very close link between real economic activity, as in trade, together with financial conditions. So financial conditions are going to be underpinning the working capital financing of global supply chains. And so in the past, we've actually had quite a lot of work on the link between finance and trade as well. So I think it is a very natural area for us. And as I was mentioning earlier, we also have this earlier study that has looked at the firm-by-firm trade relationships as well. On the insurance special feature, why don't I turn this over to Claudio?
The answer is relatively simple. It's part of our remit to scan the financial environment to identify potential risks, particularly systemic risks. And this is what the special feature does, to boil it down to the bottom line, the simplest message. If you have a system in which you have riskier and more illiquid assets backed by less capital, well, that's something that obviously should attract someone's attention and doesn't really make the system safer. You're absolutely right that, in fact, I would like to stress that we're not the first ones to identify the issue in general. In fact, some of the numbers also come from a report that the IAIS has produced on asset-intensive reinsurance around the world. This is an issue which is on the radar screen of regulatory authorities. You can think of our piece as providing further encouragement to strengthen attention to this area and to pay more attention to this area and to strengthen regulation and supervision generally in the sector. Also, of course, through, and in particular, international cooperation, because as you saw, some of this has to do with shifting of assets across jurisdictions.
Thank you very much again, and we will see you in a couple of weeks again. Thank you.